And welcome to Moneycontrol. The big news as far as markets are concerned today is the results of the mutual fund liquidity stress test that has kept the markets anxious over the past few sessions. Finally, the results are trickling in. There has been quite some trepidation over whether fund managers will be able to will be liquidating some of their illiquid stocks to look good in the stress test and so on. No more suspense. The stress test results have started trickling in. And to talk about all of this and more, we have a market veteran and fund manager who has done exceptionally well in terms of performance in the past few years, founder and CIO of Quant Mutual Fund, Sandeep Tandon. Sandeep, thank you so much for joining me this morning.
Yeah, thanks, Mahalakshmi.
So, Sandeep, you were the first to declare the stress test results yesterday evening. Take us through, I know the number is 22 days to liquidate 50% of your portfolio as per the standards that SEBI and AMFI have defined. 11 days to liquidate 25% of the portfolio. What's your take? Is this liquidity did it really give you anxious nights?
Mahalakshmi, frankly speaking, no. In fact, I fail to understand this narrative of this stress has become so meaningful now, and everybody is stressed out. Actually, it's become like an event risk or something big has happened. If you really sit down and analyze globally, most of the money managers, including us, who understand risk better. Anyway, we track our liquidity aspect quite well. Like, let's look at the example of Quant Mutual Fund, where exit slots are hardly 15 days, except mid and small, where we still have something, but most of the scheme exit loads are not there effectively. So obviously, the way we design and reconstruct our portfolio on a continuous basis, keeping liquidity aspect very closely, So what the regulator has asked, nothing new if you ask me as a money manager. In fact, we do much more complex work what regulator has asked. In fact, regulator has asked very basic details, which is good from the transparency point of view. And anyway, these data points we provide in our monthly fact sheet, rather than just looking at the, let's say, a beta calculation or the standard deviation, in isolation with the market. I think much larger perspective is to look at even better risk-adjusted measure, whether you talk about Sortino or Sharpe, Jensen Alpha, or upside capture, downside capture, or similarly upside deviation or downside deviation. So I think if you just look at these data point, isolation does not give you much. Yes, it gives you some perspective, but if you start capturing the risk-adjusted returns, what we are anyway providing in our fact sheet, not only for these two mid and small cap schemes, but as a house, we provide for all the schemes put together. So for us, this is nothing new that something has come up. The only thing is additional disclosure on the website. And anyway, we do it much more complex than what regulator is asking. I think it's a step in right direction. Gradually, the regulator will also encourage to give much more data point the way Quant Mutual Fund is giving in the fact sheet. I think someday will come where the regulator will ask all the AMC to provide these data because they are far better measured. But somehow the narrative got built that some big crisis is there. Stress test people will fail. First of all, I call this as a good transparency aspect. That does not mean that all the mutual fund mid and small scheme will shut down one day. Now if you really look at least the last 33 years or 35 years of my career in the market, I have never seen any phenomena. These are theoretical, have you ever visualized RBI coming out saying that how many days banks will take to unwind this thing? Have you come out Ministry of Finance or coming or ROC saying that how many days this company will be wind up? These are going concern. So I don't think one should start misinterpreting what regulator is asking. That does not mean that we have to close down our units or the mutual fund schemes of mid and small cap capacity. What they are highlighting, just give us a perspective how liquid is your schemes, what sort of risk you are running in your schemes. That are the data points. I think a narrative got built that as we have to unwind all these schemes in one fine day, how many days it will take. This is a theoretical exercise and good from a transparency point of view. I think market has misinterpreted, and I think including media, everybody has played their own role in hyping this issue. And unwarranted investors have suffered a lot. Frankly speaking, it's nothing new phenomena for the mutual fund industry. I'm sure most of the mutual funds do calculate all these things. They have risk officer looking into these data points on continuous basis. So I don't think that one should try to read too much about it, except more disclosure and better transparency, nothing beyond that.
Sure, fair enough. Sandeep, I think one point, of course, from the regulator's perspective is to just, going by one episode, the Franklin Templeton episode, that, there is this genuine concern that, will there be a situation if markets were to turn really adverse and investor sentiment were to take a beating, whether there will be some funds who will come back and say, hey, we are not able to meet redemption, so we might have to, take a few days. Can we shut the redemption window? I think that is the primary concern. But having said that, I think one concern that the market has had is that will this liquidity, the number of days, the way it is calculated, and the liquidity position of a fund, when you look at juxtaposed it vis-a-vis traded volumes in the market, will there be some kind of thought amongst fund managers to start to look good, make their portfolios a little more look more liquid? Will there be some kind of unwinding in certain counters? Do you think that could happen?
So I'll answer that, Mahalakshmi, in a very different manner. It's a very theoretical exercise, as I said in the beginning. Let me explain you. The first question you talked about is that our issue happened with one of the mutual fund on the debt side. Okay. First of all, we have to understand the debt side mutual fund versus equity are two different phenomena.
Right.
When the debt side mutual fund, if rating gets downgraded or some valuation or some fundamental get data change, the paper become completely illiquid. There are no takers for that. Okay. So you can't compare a liquidity scenario with a debt fund versus equity. That's a point number one, which is people have to understand it very clearly. No point comparing a Templeton like scenario, what happened in the past, and something what we are looking at. Okay, it's nothing is going to happen. Okay, point number two, when you talk about liquidity aspect, okay, we also have to look at the liquidity not in isolation. As we always say, the depth and the breadth of the capital market is also rising and increasing as the country GDP is growing. So you can't compare a current scenario of liquidity versus what happened in 2000 today. Compared to 2000, global liquidity, including India liquidity, is few hundred times of that number. Okay, so we have to keep in mind that over a period of time, Indian capital market liquidity is rising. Okay, risk appetite for India as a country is improving. The perception analytics for India as a country is to the next level. All this background is very constructive background for India and India equity. Okay, with that background, if you say that everybody has to unwind one fine day, it's a theoretical exercise. As I said, never going to happen. Last 30 years of my career, I have never seen. We have seen the worst case scenario is Lehman. Okay,
right.
It was the global liquidity risk, and I'm saying Lehman was a global liquidity risk. Okay, which played out, and the worst risk, which we have seen, unknown risk which hit us, was the COVID. Okay,
right.
Now we have not seen any crisis in Lehman in the mutual fund industry. We have not seen any crisis in COVID. You have to understand that today, retail investor is very more mature now. And retail is the one last investor who get panic and withdraw money in with a huge losses. It's only the treasury benches or the HNI or family office who are generally perceived as a smart. They tend to move out first because their risk appetite is very limited. Okay, where retail investor come from a long-term horizon who put money in saving, because ultimately equity as an asset class give long-term returns. Okay, so I think this mass has very much understood post-COVID by retail investor, and that's the reason I've been saying the last 4 years something has changed. The behavior characteristic of retail has changed a lot, and if you really look at in last, let's say when the circular came and a regulator has been talking about this scenario, if something has changed in terms of massive redemption in the mutual fund industry, it doesn't look like. Is something, if I look at our end, whether inflow has reduced considerably, answer is no. Our inflow remains the same. 1 or 2 days, if you see redemption marginally moving up, that's a part of normal business. Okay, if this trend continues, saying that every day I'm going to see higher redemption than the inflows, then something you need to worry, which this is not the case in the current scenario also. And even you look at in last 4 years, when we say that it's a decisive bull run in India, and even let's say we are in difficult phase of bull run, in last 4 years, at least on multiple occasions, market corrected between 5 to 20%. Okay, is something that retail has moved out and market has not moved out. These are the phases for whatever reasons it happens. Let's say in today's context, market was slightly stretched in terms of overbought, because right from October onwards, the one-way vertical move happened. Market was not corrected at all. So
Right.
market also needs to take a breather. It will correct. It will consolidate. Sometime sub-event happen. In fact, I will say whenever market is vulnerable, okay, or for a correction or correction is due, any news which comes or any event come closer to that, that becomes a talking point. So it's a
Right.
narrative which gets built. Oh, because of this has happened, because
Right.
anyway it was correction was due. So I think as a house, as a mutual fund, we believe is a great capitulative move which leads to buying opportunity. And I don't believe that retail is panicking. It's more of a bigger customer, ultra HNI segment, family office are, they have panicked much more than the real retail investor.
Sure. Sandeep, two questions. One is that, how big is the component that rests with small cap funds that comes from HNIs and corporate desks? Is it predominantly retail and small ticket, or is it predominantly high net worth and more consolidated investors? I'm asking this question because that has very important repercussion in terms of what kind of redemption can happen. Because I think the one important data I would have expected as part of the stress test that has not come out is what is the liability profile of funds?
Okay.
Right. I mean, when you look at liquidity, you should probably be looking at asset side and liability side concurrently to see that, whether it's matched and if the fund is entitled to managing a more illiquid portfolio because it has a liability profile that is suitable for that.
So, in the current disclosure, SEBI has asked for the concentration risk of the client. So it is partly covered. Okay. But if you really look at the mutual fund as a definition, itself is meant for largely retail investors. Okay. Even ultra HNI or family office, everybody has their own family offices, money manager working for them, or so-called portfolio manager working for them. So many wealth companies are working for them. So if you really look at, I think the contribution of these so-called smart people are in the mutual fund industry, contribution is on the lower side. Okay, that's the first important. At our end, it's as in fact the entire portfolio we can say with huge amount of confidence, maybe 96% is real retail money. If you get your perspective out of that 63 or 65,000 crores we manage today, we have around 63 lakhs folio. Okay, 6.3 million retail investor folio is a very large number which we represent within the industry. So as a house, if you look at our concentration risk is what 1.2, 1.3% of the one's top 10 holding, okay, which effectively means that nobody owns more than 0.2% of the entire corpus, which is piddly, okay, which doesn't fit into the rounding error of the overall investment. So where is the question of any concentration risk coming? And it's very important, as you rightly pointed out, very important to give in more emphasis on this data and expanding it further down. Okay, if my component is that nobody owns more than 0.2% of my portfolio,
right,
then the concentration risk is insignificant. And this scenario, in how many days I will to unwind and all those things, never happen. Okay,
right.
If you understand retail behavior is a very dispersed crowd. They don't come in one fine day to redeem everything, unless like HNIs, they panic much more. Okay, because it's their main business. For retail, this is not their business. This is their saving which they are trying to multiply, or wealth effect which they are looking at. But for a lot many ultra HNIs and HNI family office, this is the core business. So small fall in the market, the panic levels at their end is far higher, and they have urgency to move out. So we have to be only watchful. If I have to look at whether it's 20 days, 25 days, 5 days, doesn't matter, because you have to look at much more quality data on the liability side, as you explained. It's very important. If the concentration of these ultra HNI family office is insignificant in your portfolio, then this is even more theoretical exercise. Okay, so we have to understand where the concentration, the problem is not in the mutual fund industry of the concentration. The problem is far higher in the PMS AIF, which are very concentrated, and it is meant to be concentrated because that is meant for the family office and ultra HNI customer. There the concentration risk is higher.
Right.
If somebody has to look into the concentration risk, It is more in the PMS AIF, not at all in the mutual fund basket. So that's the reason I think this has become such a hype thing right now, and I think it doesn't require even so much discussion, debate, which is going on this stress test, because every house does this thing on regular basis. So I'm quite surprised the ways this narrative got built about the stress is something big has happened actually in the industry, and people are so nervous about it.
Right.
Frankly speaking, there is no such event like that. One should not even look. As I said, it's a good transparency, good governance point, more disclosure. Okay, nothing more than that.
Okay, one more question, and then we will move over to more market talk. Do you see flows into small cap funds slowing down from here on? I mean, what do the fund distributors take away from all this data? The fact that the SEBI itself is saying that the markets are frothy, at least this segment of the market is frothy. What do you think the distributors will take away from this? How do you think fund houses will push various funds? I know that, a lot of them, the big ones definitely have not been pushing small cap funds. In fact, they don't want money in small cap funds and they want to divert it elsewhere. Do you see overall fund flows into small caps and mid caps slowing down from here on?
I think the way we look at it is slightly different. Okay, what we have to understand that see, let's look at 2 minutes. Let's spend a minute time on regulator. See, a regulator globally, and it's their duty to warn the market about any sort of hype getting built. It's a very common thing with regulator talks about, and that is their job, which they are doing it properly. Okay. So they keep on warning, they keep on analyzing that. What they're asking is that, if you understand what regulator is not saying you shut down small and mid cap. Okay, what regulator is asking, at least your investor should be very clear about their risk appetite. Okay, because small and mid has rallied very sharply, they should reassess their investment horizon. Are they comfortable on the liquidity of the portfolio? Are they comfortable with the risk profiling of the portfolio? This is what they're asking, and exactly the same thing which we as a money manager keep on assessing. We look at the risk appetite for the country as a large, so much larger with the risk appetite from a flow perspective is there. If risk appetite for India remains high or inching up, the global liquidity keep on attracting towards India. So the larger thesis, which is the current situation, then we look at the risk profiling of the sectors and stocks also. I'm saying if I'm going to the behavior side of the market, then forget the retail investor. We as a money manager look into the risk appetite on the sector stocks also. Then we look at the liquidity aspect very closely. And similarly, any individual or any family office putting money or HNI putting money, they should assess their risk profiling. Because what happens sometimes, lot of people come in the market after certain up move which has already happened. They get excited and say, I'm a long-term investor for 10 years, but they are not. Okay, one fall actually shake them, because everybody talks about long-term, but in practicing this long-term thesis is not there. The patience is not there. They give up in few months' time,
Right.
and that's the reason we as a mutual fund, when we have a fiduciary responsibility, we also keep on telling our investor, we send letter to our distributor, please reassess. We are informing investor about it, please reassess. So we are also playing a very mature role in asking that everybody should assess. But that does not mean that one should get panic, something. See what happened, if you just look at a scenario, it's like this, if RBI comes and says that how many days it will take to unwind the bank. Okay, now this is a completely theoretical exercise. Okay, can an ROC come and says how many days one particular company will take to unwind? Because we have to understand companies are going concerned, mutual fund, asset management companies are also going concerned. This is a continuous business which we are doing. Okay, so and if India is growing, it should not happen. India keeps on growing, India GDP is growing, everybody is happy. And then Indian capital market will not grow, Indian capital market depth and breadth will not grow, Indian life insurance mutual fund will not grow. That is not going to happen. That's the reason I'm saying it's an academic exercise. What regulator
No, but
wants,
will this sober down flows into small and mid cap funds? My question is that because one of the reasons that in the last 1 year there has been such a sharp up move, and I'm asking this particularly because you definitely use over ownership, under ownership, and a lot of other technical parameters are very central to how you pick stocks. And it's not just valuations and other things. So will flows get moderated, which means and should that make us believe that there will be some kind of moderation in the way small caps and mid caps will move in the next few months?
So I think yes is an important question, but it is too premature to take that stand or analyze last few trading session data after the circular has come that the flow has been impacted. If I can say with
Because
whatever data.
while you said regulators' job is to do that, but then they've used the term froth. They have said trustees are expected to look at various things, including moderating flows, rebalancing of portfolios and stuff like that. So all of that essentially means that, hey guys, look at other pockets of the market, because this pocket of the market doesn't seem to look good. And everybody starts to take that seriously, means that pocket will obviously mellow down.
See, I think one has to understand that this market, what I call it invisible animal, is one of the smartest animals. Okay, and if yes, regulator observation is correct, there are certain pockets where froth is there, particularly SME segment. Okay, where extraordinary segment, the size is very tiny. The money flow which has chased over this space is something very meaningful. But what we have to understand is that, let's have an example giving talking about SME. If first of all, real retail has not put money in the SME space up to that extent, what we talk about. None
Correct.
of the mutual fund have participated. If this, even there is a froth on SME, where is the question of mutual fund participating? For us as a mutual fund, our board has not authorized us to participate in the SME. So it's a negative. SME stocks are a negative list. Till date, we have not bought even one of them. And I'm sure so is the case with most of the mutual fund houses. They have not participated. And third is aspect, if you look at, even let's say some, if you are to some HNI has participated, when you are managing very sizable money and you put 2-3% of your portfolio, 5% money in the SME, maybe in value terms it looks very large. But if you look at for his diversification, he's put just 5% of his portfolio. It doesn't matter to him when he's looking diversification. So it's a very theoretical exercise when you say, oh, such a large few thousand crores has been invested. Okay. But if I look at, let's say, if I'm HNI customer, if I've invested 5% of my money in SME, then it doesn't move the needle, because I will look at the opportunity for me. Why should I miss out? Even 5% correct also doesn't matter to me in a larger thesis. So again, we have to look at opportunity both absolute terms and relative terms. Similarly, returns has to be, or risk also has to be observed both in absolute and relative terms. So it's a very a complex thing. Every individual has certain risk appetite. Every asset class has risk appetite. Okay, every individual has certain investment horizon. Okay, every product has certain horizon. I think it's a complex subject, and everybody has to take a very individualistic view, what investment horizon they have, what risk appetite, accordingly choose their products. And this what regulator is trying to say, boss, you should be aware of what you are choosing.
Sure. So, Sandeep, in your own view, now we have seen more than 10 to about, I think, 13% correction in the small cap index over the past 3 weeks. How much more do you think it can correct? I mean, in the next few months, do you think these counters, I mean, largely as a segment, small caps will be under pressure, or do you think a quick rebound is possible?
As I said that, first of all, we don't have a God status to say that this much fall can happen. Okay. But the way I said that in the beginning of the program also, there was a market has rallied sharply, so they were trading in our so logically has to correct. Okay. Now, when we all talk about corrections are very healthy, but when it happens, and sometimes brutal correction comes, it affects the health of most of the participants, which is the case which happened day before yesterday.
Right,
okay?
Right.
Now let's assess in the larger pieces. If I said in this current bull run also, which is going on globally, including India, we have said that easy phase of bull run is over now. We are in difficult phase of bull run, but we should be very clear we are in bull run. Okay.
Yeah.
So it's very important to understand that thesis. Okay, something has changed in India from a longer term perspective. India perception globally is unique right now, and both in absolute terms is very high, even relative to US, Japan, China, or even the market which is popularly or other emerging market. India is in a very unique situation. So India will remain expensive. India valuation will remain elevated because you are the center point where the growth is happening, demographics in your favor, macro is in your favor, political stability is very high. India has taken right step in multiple area. So money will keep. So it is very theoretical exercise. Valuations are stretched. Valuation can stretch for long period of time. It happened in China for long period, maybe more than a decade or more than 2 decades. The valuation was stretched.
Yeah.
Okay. Now this is something which we have to understand. That's the reason I always talk about that. One has to look at multi-dimensional data points or multi-dimensional research rather than just looking at one directional or unidirectional approach, because unidirectional approach doesn't help. Let me give you even more example on the stress test related. When you look at a beta of the portfolio, standard deviation of the portfolio, okay, yeah, it's again same problem, okay. If you look at these data point in isolation, it doesn't give much sense.
Yeah.
Like if I give example like P multiple, when you look at P multiple is high or low, does it give any sense to you? Yes, only thing, yeah, it is high, expensive. But P multiple has to be looked in terms of returns ratio. What is
Correct.
ROC? What is ROE?
Correct.
If
Correct.
any company multiple is higher, is that because its multiple is higher because it generates superior
Return
returns.
on
The
capital.
ROC or the ROA will be on the higher side. Similarly, when we look at in isolation, these doesn't make sense. That's the reason our fact sheet and even in this the current sheet we have informed investor about additional data points. You have to look at the risk adjusted measure like Sharpe ratio, Sortino, Jensen alpha, or upside downside protection or deviation. Okay, so those are the data points. Anything which is risk adjusted returns gives you much holistic picture. Then rather than just saying 5 days liquidation, 10 days liquidation doesn't make sense. Standard deviation is a deviation. Okay, whether it's positive or negative, it doesn't make any sense if you look at just standard deviation. Okay, what is very important? Understanding of the portfolio construction, what environment this sector weightage has been given, stock weightage has been given. So it's a very, when we look at as a money manager, this is what we tell to distributor also. As a distributor, you have shortlisted us as money manager. Leave the this sort of exercise on us. Similarly, we also request the investor should leave that part on the money manager. They are more equipped to handle these things rather than getting panicky. Oh, this has happened. A
Sure.
lot of people have been asking this. Let's say example, our mid cap has 6 days thing, or in small cap has 22. There's a lot of people we got call on thing, now it will take, now my redemption will take 6 days, my redemption will become T plus 22. This is the way the narrative get built. Actually we
Right.
got queries
Right.
about it. So we are pacifying, and that's the reason when we written a note to investor yesterday, we actually, whole idea is to pacify them. There is no such crisis, there is no such big event which people are worried. What regulator is saying, please give me more data, please be more transparent, please share your risk profiling. This is what they're asking.
Right.
And anyway we do it, and if you start reading too much into it,
Right.
and everybody
No,
is
I
just
don't want to. I don't want to talk about the fund investor or the or this stress test at all. I want to have your views on the small cap, mid cap sector, and do we steer? I mean, in terms of market, does the focus now go back to large caps? Because for quite some time, a lot of fund managers have been saying that large caps have been largely ignored. The valuation seemed to be a lot more reasonable there. There is froth in the small cap, mid cap space. Do you think we are ready for that pivot in terms of market?
So, Mahalakshmi, if you look at purely from behavior perspective, and everybody believe that it should move towards large cap, never happens. Okay,
Right.
this thesis I'm hearing not for last few weeks now. I'm hearing for a while. Okay,
Right.
and it has not played out. So let's be very clear on that part. What is very important to understand that if, again I'm using the word if, big if you are a real long term player, we have seen in long term equity and asset class gives phenomenal returns, and within equity small and mid also will always outperform a large cap from a longer term horizon. Don't talk about 1 quarter, 1 year, or one or few years sometime. Okay, but somebody has, let's say, 10-year horizon, whether small and mid will outperform. Large, answer is big, yes, they will outperform significantly. Okay, and this is what we are asking. If you have that horizon and that much patience and that thought of clarity that you will be taking higher risk in small and mid, and you have that vision, then please invest. If you don't have, then go for a flexi cap where you leave the decision to the money manager like us, who will decide on your behalf whether I have to increase my exposure towards mid, large, or small based on the risk of environment. So that's the reason Flexi cap as a popular schemes are more popular because as a money manager, I get highest flexibility. Similarly, multi-asset. If you look at the Quant multi-asset, also unique product. We look at the we get the money manager as a flexibility to manage multiple assets. Okay, I can go up to 80% cash. I can go up to percent bullion side. I can go 80% debt. I can go 80% equity. So again, flexibility is higher. So what is very important for investor to understand, if let's say market becomes more volatile, okay, and which is the case not this year, it has been volatile from 2018 itself, okay,
Yeah.
and if you believe your risk appetite is not appropriate after so much rally in a small, then move towards a flexi cap. From I'm not in a camp who says that you redeem and sit tight. Okay, I'm in a view, if your risk appetite is shrinking, or you think it has peaked out from your own perspective and you are happy with the returns which you got and you don't want to take any further risk, then please shift money towards the flexi cap. If you're very conservative, then please shift your money to the large cap. But that I'm talking about shift. We are definitely very constructive of India. So we are not recommending any of our clients that you should redeem and sit tight and move towards debt because
Right.
market has peaked out. There is no such signs of euphoria. So it's a
Right.
characteristic which everybody has to reassess their risk appetite and their investment horizon and accordingly take a conscious call.
So, but from a 1 year perspective, you don't think this shift to large caps is going to happen?
I think it is a very difficult question to answer, and that's why I say for last few years people have been saying this thesis, but didn't work out. I'm not saying that it cannot
But
happen
why
this year.
is
It
that?
can
I mean,
happen.
one of the reasons that we is very simplistic is that, you know, FIs are larger players in the large cap segment. They've not been big buyers, and therefore there is lull out there. While this whole rally is being driven by, you know, retail investors, and since domestic money and retail investors are more in mid caps and small caps, that is where we are seeing action. So, is this a are you seeing a continuation of that trend? So, what makes you you sound a lot more uninspired by large cap?
See, I tell you, as a house, we always say we are analytical house. Okay, we we very proudly say with objective is our religion and data is God. So we don't get any biases towards any large or mid or small cap based on the our adaptive asset allocation thesis, based on our predictive analytics strength. We are able to quantify on based on various data point whether I have to increase my exposure towards large, mid, and small. Okay, let's say example, till September 2021 in our small cap, we were running 100%, 99.9% small cap, zero cash. It was largely small and mid. Okay, but if you look at currently and not now after this circular, for last many quarters and last many months, we have a substantial large cap exposure. In fact, both our mid cap and small cap has closer to 28 to 30% large cap we have been running. Okay, but what is very important to understand, even the exposure which we have taken large and mid, they have actually generated huge alpha, and some of the stocks has actually generated more alpha than the small cap for us. So it's also depend on the stock selection. Okay, this was then keeping in liquidity in mind, this was then keeping in mind that is opportunity. If I'm getting a better opportunity in terms of risk profile and better returns in the large cap, it's my natural fashion that I will increase my exposure towards large cap. If I am not getting exposure, you see in the let's say in the large cap, then I will look for a mid and small also. See, what is very important to understand that people should not get carried away with now this stress test report has come.
Yeah.
Everybody is reading that now the liquid names should do very well, quality names should do very well, other things should not. Maybe partly true, but not necessarily that's the way it will happen. That does not mean I will just look at the liquidity and I will not look at the
Yes.
valuation. So
Correct.
it's a
Correct.
combination approach we have to look at. That's the reason I say this stress test give you some perspective on liquidity and risk profiling. It does not give you any quality aspect of the portfolio construction. If I look at the very detailed portfolio analytics, this stress set give you some data points. It will never able to judge the entire construct of my portfolio, including my risk adjusted returns or even the quality of the sector or stocks which we have built. And a quality is again a very relative term, relative to what is the opportunity in the market.
Right.
So it's very difficult to gauge with few data points. And we always advise investor, if you look at the track records as a money manager, what you have built in 1 year, 3 years, 5 year, and track record not only in terms of performance or outperformance, track record in the risk adjusted. So that's the reason we request everybody look at our fact sheet. We give risk adjusted returns of all the schemes, and then you take a call. Similarly, you do this exercise for the other mutual fund schemes also.
Sure.
Whichever is giving you better risk adjusted return, that's the area where you have to invest. That's a very simple way of looking these data points. What risk
Sure.
and what returns. So
Sure.
risk cannot be ignored.
Sandeep, the last time we spoke, the one sector you were really bearish on, you were underweight on, in fact, you were bearish on where everybody else, all mutual fund managers are bullish, is financials. Have you changed your view from there on? You continue to be bearish on financials?
I still continues to remain skeptical. I will not use the word bearish. Skeptical. Again, Mahalakshmi, what we have to understand is that when we invest money in the market, it's very important to understand the absolute return and relative force. Since I'm a student of theory of relativity, in life everything is relative, and returns are relative.
Correct.
So when we look at opportunity, we felt that banking sector relative returns will be far lower, and fortunately our assessment or the predictive analytic thesis which we run was right, and that's the reason we have hardly any exposure in private sector bank. Overall banking portfolio maybe not be more than 3% or 2% in our portfolio as of today. So we believe much larger thesis. I have been talking about that. If you look at, if I understand a global macro right, we have talked about in the next coming book that the relevance of leverage economy as a concept will decline, and banks are the best product, okay, to capitalize leverage economy as a concept, which if we think something is going to change further, it's already changed, and something will change further, then the whole sector get derated, okay. And if sector get derated, which is already trading in the admired territory, okay, is grossly over ownership, extraordinary weightage in the Nifty of 40% nearly.
Yeah.
It doesn't fit into our entire thesis. That's the reason. And it's not a criticism. It's our unique way of looking at data point. And fortunately, we were right in spotting that trend relative to the industry.
Right. Right. How about, you seem to be bullish on commodities. You also launched a fund around that theme. What's your take? What is your theory there? And on the power sector particularly?
So this is same extension when we say leverage economy as a concept will decline and real economy, okay, will take over. So when we saying a real economy thesis will work, because you really look at today the global leverage is maybe 10-12 times of the global GDP. So the leverage market is 10-12 times bigger, and that has, according to our thesis, has peaked out. Now money is moving towards real economy, and obviously with that thought process, commodities are the first beneficiary. So we are not looking commodities as just 1 quarter or 1 year thesis. We believe commodities, we are in super cycle of commodities. If I have to take few decades call, I think commodity cycle has bottomed out, including whether you talk about precious metal, whether you talk about base metal, and we talk about agri. Agri obviously will be the driving seat, which we have seen post-COVID. Also, the real impact was felt on the inflation and the interest rates. So as a house, we believe we are very constructive on global commodities, and it's a very large conscious call. That's the reason maybe commodities are 15% of our portfolio.
Sure. These are two very important macro trends you're calling out, Sandeep. One is you're saying this decline in leveraged economy. First of all, what makes you think why do you think leveraged economy will go down? And second thing is you're saying the super cycle in commodities is bottoming out. What is the reason for that?
See, the problem with most of the macro analysts is about that they look at just real economy data, okay? And our view is that real economy data does not drive the economy. It's the leverage economy who drives the real thing.
Right.
Today, let's say example, we all look towards derivative market data very closely. Oh, what derivative data is showing? What sort of rollovers is happening? How the long buildup or short buildup is happening? So we track the impact of derivatives very closely to equity market. And if you extend the same thesis, okay, then you get answers. Okay, so let me give you one more data point. When the banking system started, maybe few hundred years back, so we brought this concept of M1, M2 because when you talk about liquidity, everybody talks about money supply. Okay, today the shadow banking data or shadow banking is much bigger than the real banking. Okay, and that's a way we have to understand. If you don't look at the shadow banking data, let's say when banks started the only bank, today we have private equity, venture capital or virtual capital. Okay, all sort of new avenues of funding has emerged, and that shadow banking data, if you don't capture, that's the reason we spend sizable money. We invested a few $1 million in building our analytics in last 18 years. So we subscribed a lot of things. So if you understand the shadow banking data and you look at the global liquidity numbers today, then today I can say the global liquidity maybe is 2 times of the global GDP. Okay, that bigger is the global liquidity data today. Okay, and if you ignore these things, then it does not make sense to look just valuation number in isolation. And that's the reason last 6, 8, 9 months people are talking about India valuations as stretch. People give example what happened in 2007, 8, 17, 18 or even 2000. Valuation was stretched and market corrected. And market is not correcting. You leave last 2, 3 days. But because only valuation don't give you answer, look at the liquidity. What was the liquidity situation? What is the risk appetite for India? Today, India perception is very different. The global market, what happened in 2007-8 when Lehman episode happened, we were technically in a very awkward situation as compared to what happened in 2027-8. Today, we are in a very comfortable situation, rather very unique situation we are in. Okay. So when you look at these data in isolation, everybody looks at, oh, what happened. But what is the context which you have to understand? When you look at the mathematically, when you run a complex multivariance model, we try to understand if people say the cycle will repeat or not. We have to understand that if all the data points are in a similar situation, then it will repeat. Okay, which rarely happens.
Right.
But if something is changing, like we always say in our predictive analytic, you connect the dot and you see the picture, whether the picture is becoming blurred or clear. For India case, the macro picture is becoming more and more clear. It's so vocal. And I said very open, my 33 years of my career, I have never seen such phenomenal macro in my life. Okay. How can I be so negative? So if a lot of people say mid, small, or is there a problem? Because if you have a 10 years view, I will put my money. Provided the view should be 10 years, should not be 6 months. After 6 months, you say, oh, the correction happened. Oh, I never thought the 6 month market will correct. That is what regulator want, that you should be very clear before putting money, assess your risk appetite, assess your tenure. Okay.
Fair enough.
And this you exercise, you have to do it on continuous basis so that your conviction should not be shaken and you will not create any problem in the market.
Right. So I have a follow-up question, but I'll skip that. Essentially, the question I wanted to ask is, this commodity super cycle, why would you think it is bottoming out? You're talking about, liquidity goes down, the focus will be on the real economy, but then all of these assets, including commodities, are also financialized. So why would you think so? But we'll skip that for the moment because I want to ask, I'm running out of time and want to definitely ask you this question. Where do you see pockets of value right now? Your top 3 picks in terms of sectors or themes?
See, energy has been a thesis for a while for us. More than a year I have been talking about. And I think that's the thesis will continue. Okay. And value is a much larger thesis. And within value, if I see a value which is energy-centric value company, more emphasis. Metal-centric, the metal is another area where we like, because again, part of value. PSU as a theme. Now, very important, Mahalakshmi, you should understand, when most of the money managers will start evaluating whether any stock which they buy, if it has less liquidity, it will deteriorate the current matrix. Okay, and hence everybody will like to move towards liquid names. Okay, and with that background, for public sector stocks are very much apt for it because valuations, they are not expensive. Liquidity wise, phenomenal liquid name. Their free float, okay, in public sector enterprises are far higher, and hence the impact cost is far lower. So lot many mutual funds now will start reevaluating the decision to increase their PSU export purely from the comfort on the valuation. and extraordinary comfort on the liquidity. So liquidity will be a very important phenomena going forward, at least in terms of assessment. And
Right.
there's a reason we believe that IPO market will become difficult. Okay, particularly smaller caps IPO which are coming in the market, and if they are very illiquid in nature, the quantum of the liquidity which is in terms of market cap is on the lower side, they will find it very difficult. As a mutual fund, we will not like to participate in some of these names. This is the
Right.
most important takeaway of this stress test out now.
Okay. Okay. Any other sectors that you find as offer pockets of value?
So I talked about energy, metals. I think pharma still looks good to me. It has moved
Okay.
up. Maybe now money will move from the large cap pharma company to mid and small cap pharma company. Pharma as a thesis still looks attractive to me. Media is a very small we like because in the neglected space, not much is there. So and another space I think which I like from the current level is all infra names. Okay, we have seen extraordinary hype getting built in the capital goods space. Now time has come from the construction companies, logistic company. We're talking about the equipment provider companies, or okay, or anything which is larger infra. Now I'm excluding the capital goods. So
Right.
that's a thesis which I'm extremely bullish on. And then if infra grows does very well, then metals will do well. Without metals, you can't build the infrastructure. Without cement, also needs support, but you need more support on the metal side.
Sure. You said media, which is quite unusual. And in media, most businesses, are seen as, at least the listed ones are seen either in print or television and stuff like that, which is seen as a declining business.
Yeah. You have talked about which is a neglected sector and deep value. This is the area, but I said the segment is very small. So we do have some exposure.
Okay.
It's a tactical exposure. We like to own something because we think the cycle is in a neglected zone. All these stocks are trading in the most neglected or hated zone. So whenever we get this opportunity, we tend to capitalize. Given the size is tiny of this whole sector, and hence you can't take a very large bet on this. So we have taken a
Right.
smaller bet.
Sure. Thank you so much, Sandeep. It was such a pleasure talking to you. Thank you.